Hey there everyone, it's Brendan here from the Crypto 101 team, and in today's video, we're going to be explaining the different kinds of trading that Coinbase currently has available. Now, this actually stems from a question that one of you all asked on one of our recent tutorial videos. In recent months, we've seen Coinbase adding a bunch of new features and a big push towards alternative leverage options, most notably futures contracts and perpetuals contracts. So the question was, hey guys, these tutorials are great, but what's the difference between spot trading, perpetuals contracts, and futures contracts? And that's exactly the question that we're going to be answering in today's video. So with that being said, there's a lot to unpack in today's video. And all that we ask is that if you enjoy the content and you found this useful, consider hitting that like and subscribe button because we have a bunch more videos just like this one coming your way. And we already have tutorials live for spot trading, perpetuals contracts, and futures contracts. Now, without further ado, let's go ahead and dive right on in and explain the differences between all of the different kinds of trading that Coinbase currently has available. Now, I want to kick us off with spot trading first. This is the easiest and probably the most normal of all of the kinds of trading. This is the one that most of us are already going to be familiar with, but this is when you just go and you outright buy shares of a cryptocurrency, right? If you're going and you're just outright buying Bitcoin, buying Ethereum, buying Solana or XRP, and you're just getting a number of tokens in return, that's what we call spot trading. I don't think this one needs a huge explanation, but you're just buying the coins themselves. There's no contracts, there's no leverage. You're just essentially owning shares, much like you would in the stock market. Now, perpetuals and futures contracts are very different from this. In both of these, you are actually not owning the underlying cryptocurrency. Instead, we have the word contract attached to the end, which explains exactly what these things are. Now, there are some key differences, and I'm going to show you how to find these and how to navigate around Coinbase in just a moment, but I want everyone to understand the underlying differences before we go into the tutorial section of this, because you need to determine what is best for you. So perpetuals contracts are the newest addition to Coinbase. These are something that they've added fairly recently, especially in recent months, and depending on where you live, you're going to have either a lot of selection or you're only going to have a few. I know people in the US pretty much only have 4 options to trade, and again, we'll get to that in just a second, but there's a couple of things that you need to understand about perpetuals contracts. Perpetuals contracts are exactly how they sound. They're perpetual. They have no expiration date. So what this means is that they are running for forever. It's always the same contract, and you don't have to worry about getting into a new one. You don't have to worry about expiration, and they go on for essentially forever. Now, the caveat here is that there is a funding rate, and the funding rate system can vary from exchange to exchange. And typically the way that you have this paid out is you get like a fraction of a percent every couple of hours. And that fraction of a percent is paid by either the longs or the shorts. Now, the way that this is determined about who pays this funding rate and to whom, this is determined by the perpetuals price, which is the price of the contract, versus the spot price, which is the price of the underlying asset itself, not the contract. Now, oftentimes there's a disparity between the perpetuals price and the actual price, which is the spot price. So if the perpetuals price is higher than the spot price, then long traders are going to be paying shorts. On the other hand, if the perpetuals price is lower, then the shorts will be paying the longs. Now, this funding rate or this funding mechanism can vary. Again, some exchanges like to have this at a 0.4% every 4 to 6 hours. Other places like to have it at a 0.8% or a 0.12% maybe every 12 hours. So depending on where you go from exchange to exchange, you can see this vary, actually quite substantially. And not only the time that it occurs, but also the amount that the funding rate is being paid for. So depending on whether you're long or short, you could be paying or even receiving part of this funding rate. So that's something to kind of keep in mind here. And that's one of the caveats of not having an expiration, is having a funding rate to make sure that people don't sit in these positions essentially for forever without any kind of repercussions. Now, the other thing that I'll say here with perpetuals contracts is that these have unlimited downside. So when you're getting into a perpetuals contract, these are different from spot or options. In a spot or an options contract, more often than not, you can just go to zero And that's the worst of it. If you're buying a call or buying a put, or you're just outright buying shares. In perpetuals contracts, this is a bit different. You can lose more than you put in. There is theoretically unlimited downside. Now, most modern exchanges and brokerages will cut you off after a certain point if you don't have liquidity, but you can lose more than you put in. Now, on Coinbase, perpetuals contracts have a set amount of what they cost, and you can't fractionalize this. On most exchanges, you can actually select any amount of money that you want to buy into, and you can also select the amount of leverage that you want to buy into. However, in the United States, that's not the case. In the United States, you have to buy in at a fixed leverage point for a fixed amount of money per contract, and you cannot fractionalize those contracts. So you can only buy in increments of 1, 2, 3, 4, so on and so forth. You can't buy in at 3.5 or 4.5 contracts because that is not a round and whole number. So the difference here when we start getting into futures contracts is that, again, perpetuals contracts, they last for forever. And they have this funding mechanism. And again, typically speaking, if you're outside of the US, you can choose how much you put in, and you can also choose the leverage at which you want. With futures contracts, it's a little bit different. These are still leveraged contracts. You're not actually owning the cryptocurrency itself. You're just trading off of the price action. The difference here is that with futures contracts, these do expire. Now, depending on the kind of futures contract, these typically expire every couple of months or so. It's not super consistent, and again, it can vary. There's a lot of different futures contracts out there. You have CME, you have Nano, which is what Coinbase uses, and you can expect that every couple of months there will be a new contract. Now, what this means for you as a user is that you can either roll these over, or if you expire or you let them expire, then you're just going to be paid out the remaining balance. Now, the thing that you have to be careful of here is that as the contracts are rolling over from one to the next, you start to see less and less liquidity and volume on the old ones, and then you start to see more on the new ones. So as you start getting into the final half of that final month of the contract, you start seeing volume spill over around, again, the middle part of the final month of that contract, and then you start seeing it roll over, which is the term that we call it in trading, into the new one. So you have to be careful of low liquidity, and you have to be careful of, issues and that ultimately closing. So these do have an expiration point that is a set point in time, and that's something that you have to be careful of. Now, much like perpetuals, these also do have unlimited theoretical downside in your accounts. You can lose more than you put in, but with futures contracts, for most of these, you're buying in at a specific contract rate. Futures contracts work in ticks, which is to say every set of cents typically is the way that it works. Every 25 cents, maybe every dollar. It can vary from asset to asset, but every set interval that it moves in terms of usually cents or dollars, then it's going to be worth X amount of money. Now, if you've ever traded a traditional futures contract, such as like NASDAQ, for example, then you can understand that if you're buying in on CME, then every single tick might be like $5, for instance, for an E-mini. And so that is the way that it works. Every 25 cents is one tick. Every tick is $5 per contract. And with futures, on crypto, especially with nano futures, they work in a very similar way. So every set amount that this moves is going to be multiplied by a percentage amount. Now, these percentages can change a little bit due to supply and demand and market conditions, but they tend to stay around the same amount per asset, but they will vary from asset to asset. Now, I know that's a lot. I know that might sound confusing, so let's break it down. If we're looking at a couple of these different assets, and I'm going to move us over actually to a screen share here so that we can look at it, but if we go and we look at Coinbase, for example, and we go to this section for futures contracts, you can see that we have a lot available. Now on Bitcoin, if I wanted to buy into one of these here, I'm going to have 10x leverage, and the contract's going to cost $117. Now, if I go to Solana, for example, it's going to be a different scenario. Say I wanted to trade one of these. Well, Solana is going to be 5x leverage, and the contract's going to cost me $239. What if I go to Dogecoin, right? And I want to buy one of these. Well, this contract's going to be $337, and I can only trade it at 4x leverage. So that's going to be another thing that you have to think about for these futures contracts. So then they tend to stay the same around how much leverage there is per contract. They will vary from crypto to crypto and asset to asset. So there's going to be a little bit of variations that can happen here. So let's recap all three of these, and then let's actually walk through the exchange and show you all how to do this. Number one, spot trading. That's normal, just trading shares of underlying crypto. You're buying one Bitcoin, one Ethereum, one XRP, one Solana, so on and so forth. Futures contracts. These have an expiration point. Every couple of months, there's a new contract. You have unlimited downside, and you typically have a set amount of leverage that happens with each futures contract. Perpetuals contract have no expiration date. However, they have that funding rate mechanism that we talked about, and they also have unlimited downside and upside. Typically, depending on where you live, you can choose your leverage amount, and you can also choose the amount of money that you want to put in. If you're in the US, it's going to be different. You're not going to have a say in how much you put in. You're going to be forced to buy contracts of a perpetual, which is a bit uncommon. But in the US, things have to be done a little bit differently. Also, if we go back to the screen share here, we can see that the perpetuals options in the US are limited to Ethereum, Bitcoin, Solana, and XRP. If you go to all and you're outside of the US, you have a lot more options in here. Now, if you go to futures contracts, even if you're in the US, you're going to have a lot of different options here. Typically, you want to be trading the most immediate contract, and most of the time, Coinbase will only let you trade the tradable contracts or the contracts that have the most volume. If you go to all, of course, there will be more options here if you want to trade these. But again, for our US traders, that is something that you're going to have to pay attention to. Now, to navigate here in the first place, you need to go to the bottom left of your screen. You need to click on the advanced button, make sure it's toggled on, and then you just go to the derivatives section after you load into this page, and you're going to see that there's all three of these options that we talked about with spot trading, futures trading, and perpetuals trading right up in here. Alternatively, if you want to look for a specific asset, you can type in their ticker symbols, or you can type in their names if you want to as well, and they're going to be able to come right up into this box. So I hope that this video helped you out. I know it was a bit of a longer video, a bit more complicated than we're probably used to, but there's a lot to unpack, and I want to make sure that everyone gets the full picture before they decide to go and start trading something like this. So if you like this video, again, make sure you hit the like and subscribe button. We already have tutorial videos out for how you can trade spot, how you can trade futures, and how you can trade perpetuals contracts on our YouTube channel. So make sure to check those out as well. Thank you all for watching, and we'll see all of you in the next tutorial.